Rich Dad, Poor Dad. So let's start our audiobook and let's play it here of our audiobook. Let me see. How I cancel.
Dad after school and on the weekends. Mike and I often spent hours after work just sitting at a table with his dad while he held meetings with his bankers, attorneys, accountants, brokers, investors, managers, and employees. We learned more sitting at his meetings than we did in all our years of school, college included. Mike's dad was not school educated, but he was financially educated and successful as a result. He used to tell us over and over again, an intelligent person hires people who are more intelligent than they are.
That's quite profound, isn't it? An intelligent person hires people more intelligent than them. Okay, so that talks for itself. So that means if you work for any big organization, and you should be highly qualified, and all the studies you would have done. So that makes sense, because other people who start the business, or they are the founders of the business, they may not have to be. A lot of time you'll see that they're school dropouts. That's so true.
So Mike and I had the benefit of spending hours listening to, and in the process learning from, intelligent people. But because of this, both Mike and I just could not go along with the standard dogma that our teachers preached. Occasionally, Mike or I would ask our teachers how what we studied was applicable, or we asked why we never studied money and how it worked. To the latter question, we often got the answer that money was not important, that if we excelled in our education, the money would follow. The more we knew about the power of money, the more distant we grew from the teachers and our classmates. My highly educated dad never pressured me about my grades. I often wondered why, but we did begin to argue about money. By the time I was 16, I probably had a far better foundation with money than both my mom and dad. I could keep books. I listened to tax accountants, corporate attorneys, bankers, real estate brokers, investors, and so forth. My dad talked to teachers. One day, my dad was telling me why our home was his greatest investment. A not too pleasant argument took place when I showed him why I thought a house was not a good investment. The argument illustrated the difference in perception between my rich dad and my poor dad when it came to their homes. Poor dad thought his house was an asset and listed it in the asset box. And the rich dad thought it was a liability and put his home in the liability box. I remember when I drew a diagram for my dad showing him the direction of cash flow. I also showed him the ancillary expenses that went along with owning the home. A bigger home meant bigger expenses, and the cash flow kept going out through the expense column. Today, I am still challenged on the idea of a house not being an asset. And I know that for many people, it's their dream as well as their largest investment. And owning your own home is better than nothing. I simply offer an alternate way of looking at this popular dogma. My wife and I would love a bigger, more flashy house to impress the Joneses, but we know it is not an asset. It's a liability since it takes money out of our pocket. So here's the argument I put forth. I really do not expect most people to agree with it because a nice home is an emotional thing. And when it comes to money, high emotions tend to lower financial intelligence.
High emotion tends to lower. Well. Lower the financial intelligence. So high emotion tends to lower the financial. Okay. Let's hear that again.
An emotional thing. And when it comes to money, high emotions tend to lower financial intelligence.
Tends to lower. High emotion tends to lower the financial intelligence. Mhm.
When it comes to houses, I point out that most people work all their lives paying for a home they never own. In other words, most people buy a new house every so many years, each time incurring a new 30-year loan to pay off the previous one. Even though people receive a tax deduction for interest on mortgage payments, they pay for all their other expenses with after-tax dollars, even after they pay off their mortgage. Then there are property taxes. My wife's parents were shocked when the property taxes on their home went to $1,000 a month. This was after they'd retired, so the increase put a strain on their retirement budget, and they felt forced to move. Also, houses do not always go up in value. I still had friends who owe $1 million for a home that will today sell for only $700,000. Finally, the greatest losses of all are those from missed opportunities. If all your money is tied up in your house, you may be forced to work harder because your money continues blowing out of the expense column instead of adding to the asset column. The classic middle-class cash flow pattern. If a young couple would put more money into their asset column early on, their later years would get easier, especially as they prepared to send their children to college. Their assets would have grown and would be available to help cover expenses. All too often, a house only serves as a vehicle for incurring a home equity loan to pay for mounting expenses. In summary, the end result in making a decision to own a house that is too expensive in lieu of starting an investment portfolio early on impacts an individual in at least the following three ways. Number one, loss of time, during which other assets could have grown in value. Number two, loss of additional capital, which could have been invested instead of paying for high maintenance expenses related directly to the home. Number three, loss of education. Too often, people count their house, savings, and retirement plan as all they have in their asset column. Because they have no money to invest, they simply do not invest. This costs them investment experience. Most never become what the investment world calls a sophisticated investor. And the best investments are usually first sold to sophisticated investors, who then turn around and sell them to the people playing it safe. My educated dad's personal financial statement best demonstrates the life of someone in the rat race. His expenses seem to always keep up with his income, never allowing him to invest in assets. As a result, his liabilities, such as his mortgage and credit card debts, are larger than his assets. My rich dad's personal financial statement, on the other hand, reflects the results of a life dedicated to investing and minimizing liabilities. His assets greatly exceed his liabilities. A review of my rich dad's financial statement is why the rich get richer. The asset column generates more than enough income to cover expenses, with the balance reinvested into the asset column. The asset column continues to grow, and therefore, the income it produces grows with it. The result being, the rich get richer.
Wow. So that's a very good example, or the explanation. You love it. So why do the rich gets richer? Is when the asset, what is putting money, in your hand. So the asset creates that income, and when the income is more than your expenditure, so that means that whatever that surplus is, that invested back into the business, and that creates more income, and that is how it keeps increasing and increasing. So that's good.
The middle class finds itself in a constant state of financial struggle. Their primary income is through wages. And as their wages increase, so do their taxes. Their expenses tend to increase in equal increments as their wages increase, hence the phrase, the rat race. They treat their home as their primary asset instead of investing in income-producing assets. Remember, the most important rule is to know the difference between an asset and a liability. Once you understand the difference, concentrate your efforts on only buying income-generating assets.
Income generating asset. So that's it saying that you should be concentrating your focus and attention on income generating assets. So that's powerful. All right. With that, we are done, guys. Talk to you